Okay, so let's start. I think that I would like to start the seminar with some information about the homework and about the midterm exam. Well, have you seen the homework guidelines in the Smart LMS?
Yeah.
Okay, so well, they are in Smart LMS. So if someone haven't seen them, please look in Smart LMS. For it to be more clear to you, let me show. Can you see the screen?
Yes.
So in the Smart LMS, you will find two Word documents with guidelines. And in one of these documents will be a link for this spreadsheet in which every student is assigned to 5 companies. 5 companies from S&P 500 index. So you take these companies and download the data for the stickers from Yahoo Finance and then make some calculations regarding the guidelines. Here on the tab of S&P 500, you will find the list of the companies with some description. I don't know if you need this, but it may be interesting for you to look at what companies you are working with. Yes, and probably you will have some problems with downloading the data for the index itself. That's why I put a separate tab here with the data for index. So for the sticker, so you can take the data for index just from the spreadsheet. Okay, so if you will have some questions, please contact me or Viktor Valerievich. The deadline for this task is 26th of December. So it's actually after you have finished your exams. So I hope you have a lot of time to do the exercise, the homework. So, and it is like, it's not very sophisticated. So I hope it won't take very much time. Yeah. Okay. And about the midterm. So the midterm will be on the week before the exams, before the session, yes. So with 90% probability, it will be on the 14th of December before the lecture. But we will announce it, I think, next week on the lecture. Viktor Valerievich will announce it officially. Yeah, and it will contain questions from 6 topics. So from the first, like for the stocks, for bonds, for NPV, introduction topic, and one topic about a topic about risk, which we are going to work the next week. Okay, so any questions for now?
I'm sorry, what types of tests will be on the midterm? It will just be theoretical or solving some tasks? I just haven't got an idea.
What type of questions, you mean?
Yep.
There will be some problems like we are solving on the seminars, but you won't be like you won't have to upload the solution, but the result. Yes, so one like only the result. So the test will be online, of course, with proctoring, and so you will have 10, if I'm not mistaken, 10 questions. We have a very big bank of questions, so the questions probably will be different for every student. So the problems will be similar to which we're going to work and to which we are working on the seminars.
Well, I have another question. So, am I right that we will be able to use some our solved exercises from the seminars, or we won't be able to do that?
Actually, I'm not sure about it, and we will actually discuss it with Viktor Valerievich, but I think that you won't be able to use, like, for example, the Excel from the seminars, but you can use it for preparation. Yeah. So,
Okay.
but we will discuss it.
Okay, thanks.
It can be say only for the seminar materials, or we can prepare something for us. It is open book or closed book exam or midterm.
It is closed book midterm.
Yeah. Okay.
So we will discuss if you can use your like Excel with the solutions, but like be prepared that you won't be able to use it. Yeah, but we will discuss it with Viktor Valerievich.
Okay, thank you.
Okay, well, let's start. We had, if I'm not mistaken, one task from the previous seminar not solved. So who can start? Who is speaking?
Daria Patsuk.
Okay, let's start with you. Yeah, so you are group 2, yes?
Mm-hmm.
Mm-hmm.
So the first step was to find discount factors. The formula is 1 divided by 1 plus the spot rate. It's
So actually,
of 1 and 2 and so on.
yeah, the important point here is that the discount factors for every period are different. Yeah.
Yep. The next step was to count PV for each bond. It is counted by payment multiplied by discount factor. And the last step was to find the bond price, present value. But before this, we needed to find the face value, and it is like the last price which was in line.
Like the last cash flow, yes?
Divided by 1 plus the percent of the bond.
Yeah, not the percent, but the coupon rate.
Yeah. Yep.
And so actually, for everybody, like to be on the same page, actually it's clear from here that if we have a coupon of 5 and here we have 105, the face value is 100. Yeah, so but you haven't, but it's nice that you calculated it like in a formal way. Yeah, that's nice.
And the last step is to sum all the PV, all the cash flows, and then divide them by the face value.
Yeah.
And just to find the percent.
Yeah, so that's what you are going to have if you open your trading system and look for some bonds. So you are going to see the percentage of face value as a price of the bond. Okay, is it clear for everybody? Can we move on?
Oh, just can you repeat please, why do we divide the sum of PVs on the face value? So
why we divide?
Yeah, on the face value.
So actually the task was to find calculate the present value as a percent to face value. So that's why we divided.
Okay.
Well, it's actually to show you that in real life you will see this like this value. Yes, not the nominal value of the price, but the price in percentage. of the face value. So face value is not always 100. So we had here like for example 50 and 1050. So the face value will be 1000, but the price in percent, it will be the same.
Okay, thank you.
Okay. Well, so let's move on and start our today's seminar. Well, today we're going to discuss the stocks. And well, can someone please tell me what is probably the most popular way to value the common stocks? So how we do it in most of the times?
You mean that we do close price or?
Yeah, well, how we find the price? So we take close price from Yahoo Finance, for example, but how is how can we calculate the fair price of the stock? Knowing some of the parameters of the stock. So how we can value it?
Can we just divide the gross number? Well, the value divided by the number of shares. You mean that?
Well, yes, we can. But how can we find the value?
Maybe just by dividing company stock price dividend by its most recent reported earnings per share.
Well, actually, I'm talking about like if we see some price in the trading system, we know that this company, like the stock of this company, costs 100 rubles. How can we find the fair price? So we can make our own calculations, knowing some parameters of the bond, right? And you have done it on the lecture. So we are going to find the fair price of the bond to know if this bond is undervalued or overvalued. So we need to make our own calculation, yes, of the price. So how we can do it?
Maybe knowing the future value and the dividends.
Yeah, the dividends. Yeah, that's actually very important. So the dividends of the bond are like coupons of, or dividends of the common stock are like coupons of the bond. So basically, like probably the most popular way to value the bonds or the stocks, I'm sorry, is to look at the dividends, yes, and discount the future dividends of the stock. Well, but we have a question. So some people, if you say them that you're going to value the stock using the future dividends, some people can say you something like this. So you say that stock price equals the present value of future dividends. That's crazy. All the investors I know are looking for capital gains, but not dividend gains. Yes. So how can you defend your approach to valuing stocks by dividends in this case?
Can I answer the question?
Yes.
Try to answer. Well, those investors, they may get the return maybe from capital gains. But our future stock depends on sequence of dividends, I guess.
So actually, the capital gain is some change in the price of the stock, yes? But the price of the stock, the future price of the stock, will be also valued using the future dividends, right? So we have nothing wrong here. So we value the stocks using the dividends, and we have no inconsistency in this case. Yeah. So is it clear?
that there is no mismatching, right?
Yeah. So the price, like if you want to, like you can have the capital gain, like in some, for example, months, yes, but the price in some month will be also valued, like the price of the stock will be valued using the future dividends. Yes, so today we can value the stock using dividends, and we have no inconsistency like in our logic. So our logic is not ruined.
Okay, yeah, thank you.
Okay, well, let's move on. So, well, today we are starting with not with calculations, but with some we can think about stocks, how it works, and etc. So we have true or false exercise here. Let's do it in the following way. So I won't read all the statements. You can read it yourself and then write in the chat what do you think, are they true or false. So and then let's discuss. Like not to waste time on the reading. So can you see it well? I can
Yes.
bigger. Okay, so take a couple of minutes to do it. Okay, Tatiana, why do you think that the first is true?
Actually, because on the lecture it was said that the rate of return is also called market capitalization rate for common stock.
Mm-hmm. Yeah, actually, it's true by the definition here. So it's just the definition of
And that's
market capitalization rate or cost of equity capital. And how can we call the cost of equity capital like another way? So can you provide some synonyms to it?
Don't know actually. It's how it is called.
Yeah, actually, well, any other suggestions maybe?
Maybe cost equity. Cost of equity.
Maybe
Yeah,
the
that's
assets of
that's written here.
maybe the assets of the company.
Opportunity cost.
Who was speaking?
Maybe
was-
opportunity cost.
Okay, I'm Arina. Arina, provide your thoughts.
So maybe.
Just
Oh, sorry. Alina or.
Oh my. So Arina.
Okay, I maybe it's opportunity cost. No.
Yeah.
Yeah.
Opportunity cost of capital or the interest rate of alternative investment opportunity with the same risk or the discount rate. So they are all the same. Okay. Well, Georgi Andreevich, why do you think that the next is false?
The next, the second one or the first one, I just
The second.
haven't understood.
The second. So
Because the risk is the same, so just it is not intuitively clear. Like there are histories of the companies which cannot be I think evaluated precisely just because the risks are the same. So we have to know more background about the companies. That is my position.
Well, okay. Does everyone agree?
I guess here we can talk about stocks, not securities. Yeah, and
Yeah, but we can actually here we can talk about any securities actually.
Can I maybe the expected return is it depends not only on the risk but on the other things. So in the end, it cannot be same probably.
Okay, Polina Zinchenko,
yeah.
can you
Yeah,
provide your thoughts? I think it's true.
Yeah, I agree with the second point because there was a phrase in the book that this is a condition for equilibrium in capital markets that well function, and so that is why it's true, not false. And there was an example with a firm that risk class were expected return was approximately maybe 10%, and then if actually there was a long example, and if anyone want to read it, they can find it in the book. But it was a common sense that this expression is true because it's a condition for equilibrium in well-functioning capital markets.
Yeah, so that's what is called the law of one price. It was on the, I think, on the previous lecture about bonds. Yeah, so all security stocks, bonds, or some derivatives and etc., if they have an equivalent risk, they should be priced to offer the same expected return. Yeah, so that's why we are using this alternative cost of capital, these discount rates. Yeah. So again, the securities with the same risk should provide the same expected return. Okay. So the risk and the return are connected very, very closely, so functionally actually, in the effective market. Okay, what about the third? Let me see in the chat. Aygul, can you provide your thoughts about the third one?
Well, I think this is false because we can discount returns for different periods with different rates. Well, and I think it is possible.
But does it depend only on the rates? So for example, if the rate is one, like we have one discount rate for every period, is it still possible to value a firm? So, well, actually it's possible because it like we should just very accurately project the cash flows for this firm. So why cannot we value this firm with a very high growth rate? Why not? So a lot of firms or startups can have very high growth rate for the first few years, but they are valued very like in a very simple way. So maybe when you're going to work in some financial management or in some fund, you will every day you are going to value some startups with very high growth rate for the first years. So it's not very sophisticated. Okay, well, what's next? Diana, can you provide your thoughts about the next one?
Okay, actually, I think when it is true, it's more difficult to say why it's true, because it just logic. I don't know how to explain it. A large percentage of the total value of growth stock comes from the present value of its growth opportunities. I think that that's okay. Just the largest part over.
Well, actually, it's common sense, right?
Yes,
So
I don't know how to explain it, but I think that you understand that the present value over takes the hugest part of the future growth opportunities.
Yeah, maybe it's not the hugest part, yes, but a very large part. So we can, like, on the common sense level, we can see that, for example, we can value a startup with high growth higher than some traditional company with a very small growth. Yes.
Yes.
Okay. Well, and the final one, let's talk to Alena.
Okay, yes, so I think it's true, because just looking at the formula, we can see that there is well, a difference.
You think?
I think that's true.
Think it's true. Okay. Well, let me see what other people think. So you all think that's true. Okay, let's look at the formula then. So 1 second. So actually this is the formula. Yes, so the price depends on the dividends, the discount rate and the growth rate. And if we transform this formula to find the expected return or the discount rate, actually we are going to have dividend yield plus the growth rate.
Yeah.
Yeah, so here we have minus. So
I see.
So that's false. Okay. Well, is it clear for everybody? Can we move on?
Yes.
Okay, so then let's go to the spreadsheets. I will copy the tasks. Okay, so let's start with a very simple task. So we have some company X. Well, can you see the text from here, or should I make it a little bit bigger?
It's okay.
So I can do it like this. Okay, so we have a company, some company X, and we expect that the company will pay a dividend in the end of the year of $5 per share. And after this dividend is paid, you expect to sell the stock of this company at this price, 110. The market capitalization rate is 8%, or the discount rate or the value or the interest rate of the alternative investment opportunity with the same risk. So it's 8%. Please find the current stock price. So let's have a minute to do it. And then please raise a hand in the chat. Well, not in the chat, in Teams. Oh, I see that somebody have raised the hand already. So, well, let's wait for a minute. Well, we actually have discussed now with Viktor Valerievich about the midterm. So it will be closed books, and you won't be able to use the Excel from the seminars, right? So you will be able only to use the Excel without anything, so for your calculations, right?
And it will be Examus, yeah? Or proctoring on which platform?
Yeah, I guess et.hsc.com. So, well, it's a tough question for me. So probably yes.
Probably.
Could it be,
So
could it be
during the
not
exam, we can open the new spreadsheet and calculate is there something.
Vladislav Viktorovich, could it be not
Yeah.
Examus, please? It's awful. It's the least happiest thing in my life, probably.
Well, actually, well, it will be what it will be. So I will check this issue and write you what platform we are going to use. But we have a platform in HSC for exams. Yes, I'm not sure that it is the same as Examus, but we have an official platform of HSC. I don't know on which of the proctoring platforms it's built on. Yes, maybe on Examus. So I will check it. Okay, and yeah, you will be able to open a new spreadsheet in Excel and make calculations there. Yes.
And also we won't be able to use any handwritten notes, yeah, with formulas, for example.
Yeah, that's a good question. Probably not, because we cannot check, like using the video proctoring, can check that you are not using the telephone, for example. Yes. Well, actually, I don't think that there will be problems for which you can, like, you need to use some kind of very sophisticated formulas that you cannot remember. Yeah, so basically the formulas that we use on the seminars are quite simple. Okay. Well, let's discuss, if you will have some questions, let's discuss it after the seminar. So let's now talk about the exercise. So Paulina was the first to raise the hand. So Paulina, can you show us the solution?
Yes. I just used the formula that was given to us on the lecture, where the price is equal to the sum of the expected dividends and the expected price. divided
Yeah.
by 1 plus the market capitalization rate.
Yeah. So this is actually the cash flow that you're going to have in 1 year. So in the end of the year, you
Yes,
divide
so-
it. So you discount it for 1 year. That's it. Yeah. So the answer is 106. Is it clear?
Yes.
Yeah.
Okay. Well, let's move on and discuss the next task. So again, we have some company, ECY Incorporated. We expect that the next dividend payment will be 3.20 per share. Like the dividends are expected to maintain a growth rate of 6% forever. So from now on until the infinity, yes. And this company stock currently sells for $63.5 per share. So let's find the required return, or actually the market capitalization rate, or the discount rate, or the expected return. So let's find it. Let's have a minute. And then, please, can you lower the hands, because I won't be able to understand who was the first. Or are you ready to answer? Okay.
I need a second, but I was the first to sing.
Well,
I'm also ready.
Yeah, I see that Aruzhan was the first, actually. Okay, let's have a minute, okay?
Okay, sorry.
And then discuss. Okay, Aruzhan, you was the first. Let's see. Well, and please, can you all hide the previous seminars for me to more quickly find today's tasks, okay?
Yeah, okay. Sorry.
Okay, let's look.
So basically, we firstly need to find dividend yield, right? Dividing dividend by the current share price. And then just adding forecasted dividend growth.
Yeah. So we again use the formula that we have discussed today already. So this formula for the expected return, it is derived from the formula of the valuation of the bond using dividends, which we actually also discussed on the previous seminars. So it's the annuity with growth in perpetuity. Yeah.
Yep.
Okay, is it clear for everybody? Yeah,
Yes.
I hope it's clear. So let's move on. Again, we have some company, which is now called XYZ, and it will pay dividends of 3.24, 3.50 over the next 3 years. Yes, respectively. So actually, I have projected these dividends here. And the end of 3 years, we expect that we will sell the stock at the market price of 94.48. So given that we have a 12% of expected return, or the discount rate, yes, please find the current stock price, so the current share price here. Again, let's lower our hands for a while, and then when someone is ready, again, raise the hands. Konstantin, are you ready, or you just forget to lower?
Yeah, I can show it.
Okay, let's look. 1 second, let me find you. Okay, let's look.
Sorry, I made it correctly. So I just sum the all transactions, or how to say, to obtain total cash flows. Then I depreciate them with expected return and just use simple NPV formula to obtain the current share price.
Okay, let's look at your like on the second year, for example. Well,
I forgot to multiply it here.
So actually, while discounting, you need to also make it in the power of.
Yes, my mistake.
In the power of the number of years. Yes. So
yeah,
when you discount, for example, year 2, we use our favorite formula of discounting: 1 divided by 1 plus discount rate in the power of 2. Yes. Well, and if we sum this
we obtain the current share price.
Yeah. So today, this stock should cost $75 per share. Is it clear for everybody?
Yes.
So if someone has questions, please don't be shy, let's discuss it, because it's actually very simple, right? You see that we use one formula actually for every task during like 5 seminars. So that's not very sophisticated. If something remains unclear, please don't be shy to ask, and we will discuss it again. Okay. Well, Let's move on. Well, let's discuss the Universal Air Company. So, it is a no-growth firm, which means that it's not growing actually, yes, and the dividend also doesn't grow. So it has 2 million shares outstanding, and it expects to earn a constant 20 million per year on its assets. So that means that the profit of the company will be constant for 20 millions per year, and the return on the assets will be also constant. Yes. It has no debt. All earnings are paid out as dividends, and the cost of capital is 10%. So let's calculate again the current price per share of this company. Well, so again, I'm waiting for your hands in Teams. Arina, I see the hand, so let's have like a couple of minutes more because I see that other students are solving still. So, and then let's discuss.
Okay.
Let's look at the solution. So I have opened your tab.
Okay. I just suppose that the forecasted dividend is like the sum. So I just put it here the known number from forecasted earning. Then as we need it per share, I divide it on the number of shares. And then to find the current share price, I just divide the dividend by the by the rate, by the current price per share. Right, cost.
So we expect that in perpetuity, the dividend will be constant for every year. So we can use a simple formula, just divide the forecasted dividend by the cost of the capital. Yeah. So here we use the formula for perpetuity discounting. You can also do it like in like from other perspectives. So you can not forecast the dividend, the whole like dividend amount, yes, but you can forecast, for example, earnings per share firstly. So what will be earnings per share in this case?
It will be 10, so it will count it by.
So it's forecasted earnings divided by the number of shares, yes?
Yes.
It will be 10. And then to find the forecasted dividend per share, you should multiply 10
by the number.
1.
Yeah, that's how I do it.
Well, not by the number, but actually we have earnings per share. Now we can multiply it by the payback ratio. And actually, if all earnings are paid out as dividends, the payback ratio is 100%. Yes. So we can do it in this way. And actually, when you are going to prepare for the midterm and for the final exam, I recommend you not to just look at the formulas in our Excel, yes, but try to firstly solve the problems again by yourself, because here I prepare some tables for you and some framework. Yes, so maybe it's a good idea to try to do it yourself in your own framework, and maybe you will have better understanding of how to do it, right? But here on the seminars, like in order to save the time and for you to be more simple, I prepare some framework. So here we first forecast dividend and dividend per share, and then find current share price. But you can do it like this. So first we find earnings per share, then multiply it by 100% because the payback ratio is 100%. So forecast the dividend and then find the current share price. So like almost in every problem we have some ways to solve it. So when you prepare, try to first to do it yourself, but not only look at the formulas that we have. Okay. Well, let's move on. So the next task is like a little bit more longer, like more long. We have 3 stocks. We have market capitalization, which is 10%. And actually, we need to find which stock is the most valuable. So which stock is like has the highest price. Yes. We have some parameters of this stock. So stock A is expected to provide a dividend of $10 per share forever. Stock B will pay a dividend of $5 next year, but then the dividend will be growing forever at 4%. And stock C is expected to pay a dividend of $5 next year, and then the dividend growth, the dividend growth is expected to be 20% for 5 years from now until year 6, and then there will be no growth in dividends. I'm sorry, I haven't copied one part of the task. Yeah, so for stock A and stock B, we will have a very simple solution just in one line. But for stock C, it will be more sophisticated. So you can use this table to project the cash flows and then find the current share price. Okay, well, so again, let's have some minutes. Let's start with stock A and stock B and discuss them and then solve for stock C. So let's first discuss stock A and stock B. So those who are ready, you can raise the hands in the chat, in Teams, sorry. Why do I say in the chat? I don't know. Okay, Alisa, you are ready to show, right?
Yes, I wanted to comment on current share price.
Well, let me find your tab.
Yeah, 1 second.
Mm-hmm.
So to
Here.
find the current share price, we should take our forecast dividend price and divide it by our rate for each stock is 10% minus forecast dividend growth.
Yes.
And
So,
the same for the second.
Yeah. So, and what we can see, like for example, if we have similar dividends, we see that the stock with growth of dividend will be valued higher than the stock with no growth in dividends. So actually that's common sense, but it's very important. Okay, thank you very much. So is it clear for everybody?
Yes.
Okay, then let's solve it for the stock C. It will be like more complicated, but still nothing is like nothing difficult. Okay, so let's again have some minutes and then let's discuss. So actually here you should like correctly and accurately project the cash flows of this bond. So probably you cannot do the calculations in one line like in the first two cases, right? Because we have like two steps. Firstly, we have dividend growth of 20% until year 6. Yes, and then after year 6, we are going to have no growth in dividends. So we make like it in two steps. So please be very accurate when projecting the cash flows. We have a lot of time to do it because we're quite quick today. So let's have like, I don't know, 5-6 minutes just accurately to project the cash flows and do the calculations. Christina, I see that you have raised a hand. Well, don't forget about the perpetuity. So actually the dividends do not stop at year 6. Yes, so they will be they will be paid in perpetuity. Yes, but actually there will be no growth of dividends after year 6, right? So please check again. Konstantin, I also see the raised hand, but actually check if you have some growth in dividends, because we still have some growth in before year 6, right? Please check. So again, guys, we have growth of 20% from year 1 to year 6. So every year the dividend will be growing. So the dividend for the second year will be 20% higher than the dividend for the first year, right? And etc. Until year 6. After year 6, all the dividends will be equal to each other. Well, probably let's try to do it together. Christina and Konstantin raised the hands during the time that I gave you to solve it. So, well, let's start with Christina, okay? And then talk to Konstantin. Christina, let's try to project the cash flows. So what cash flow, what dividend we are going to have in year 1? Christina, are you here?
Actually, I'm not sure about my calculations at all.
Okay, so I suggest to do it together. So I will be showing the calculation, but you should help me. So what we're going to have in year 1? So we have the forecasted dividend, right?
Yep, and in the year 1 we will have 5 as cash flow.
Yes, so we will have 5. What's next? If we have 20% growth in dividends until year 6. So what we are going to have in year 2?
Well, we need just multiply 5 by 20% and then plus...
By 1 plus 20%. Yeah, no, okay, by 20%. And then plus what?
And then plus 5.
Yeah, so here we have 6. I'm sorry. Like this, yes. We have 6, then 6, then 7, and 0.20, etc., etc., until the 6th year, right?
Yep.
Yeah. So, okay, let's talk about year 1 till year 5. So what we are going to have here in discounted cash flows?
Yep, we need divided by 1 plus 10%.
Mm-hmm. So again, the formula for discounting. No sense to actually discuss it. So we discount the cash flows. So actually the main question is what to do here. Yeah, so after the 6th year, starting with the 6th year, we are going to have the same dividend for perpetuity. So we are going to have 12.44 for in infinity, right? So how we value stocks in this case usually? So we actually can use the formula from the previous calculations for stock A and stock B, right? So we have one kind of one value of dividend every year. We'll take this value and divide it by the cost of capital minus the growth rate, but the growth rate is 0, right?
Probably, yes.
Okay. Okay, Konstantin, you also raised the hand during the.
Yeah, I put growth rate into discounted cash flows and obtain different results. But it would be mistaken.
Okay, let's discuss what should we do here. So we have, for example, we take this dividend in perpetuity, divided by our cost of capital minus growth rate. So what we get by these calculations? So what is this 124 about?
The value when we have perpetuity will end, or how to say it?
Yeah, so it's the present value of the bond of the stock which will pay dividends of 12.44, right, in perpetuity. But this is the value in the year, actually in the end of the year 5, right? So because this is the future value of the dividend, right? And we calculate the present value being in the end of the year 5. So yeah, so we should discount this present value to have not the present value for this period, but for today. All right, so how we can discount it?
Maybe we have 10% as it was in the beginning, as we calculate. No, sorry, it for the current share price.
Well, so actually, if we in other words, this 124 is the price that we can sell our stock for. Yes, in the end of the 5 years, right? So that's the valuation of the bond after 5 years. So we project that after 5 years, we are going to have one dividend value every year in perpetuity with the discount rate of 10%. So that's
should divide.
Yeah.
1 plus rate in the power of 6.
Well, I guess in the power of 5, because we're in the end of the 5th year, not in the end of the 6th year. So we do not have this dividend is not paid for us still. Yeah, we in the end of the year 5 or in the beginning of the year 6. So we should discount it for 5 periods, have such a value, and then we just sum all the discounted cash flows, and that's the value of our bond. I'm sorry, today it is not the first time. So the stock, of course, it's the price of our stock. Okay, well, it's kind of like more difficult than the previous task. So is it clear for now? So we project the cash flows until the end of year 5. Then we like value our stock using the assumption that it will pay us 12.44 dividends in perpetuity every year. Yes, in other words, it's like this 124 is the price at which we can sell our stock after 5 years. Yeah, we discount this price to the present, like to our year 0 to today. So we have the discounted cash flows.
But how we discount with 10 rate or 20?
10, of course, 10. So the discount rate is 10. 20 is just the growth of our dividends in these years from 1 to 5.
But can you show formula in the cell G296? 4.90 here.
So we discount by 10%, of course, yes. Okay. Well, and we have one more task, which is actually for home solution. Let me show it. It is more simple, so it can be solved in one line. Let me highlight it in red. So here the firm next year's dividends or dividend is $10, and it is again 100 of its retained earnings. So the payback ratio is 100. So the expected return is 12%. You should find the current stock price. Oh, I'm sorry, I have shown you the numbers. Sorry. Okay, so you should find the current stock price and then make some recalculations for the situation when the payback ratio is not 100% but 50%. So the blowback ratio is also 50%. So some part of the earnings is reinvested in the company. So yeah, and this example will show you that actually the reinvestment is quite beneficial for the stock price, and like a lower dividend today can mean higher dividends in the future. Okay. Okay, so we will start, of course, the next seminar with this task. So thank you very much for your participation today. You were quite active. So let's have a couple of minutes to discuss questions if you have them.